So inshallah, we'll get started. So my name is Safeer. I think I came maybe about a month ago. We did a session on personal finance. If you did not attend that session, I think it was recorded, and you can check out the website Muslim.finance, which has more details about it. For this session, we're gonna, the hottest topic that's always discussed about personal finance is home financing and understanding what it means for halal home financing and stuff like that. And it's always like 90% of the questions that we get for personal finance. So we thought we'd do a specific session for that. And if you have other ideas, I think we have one more session that I'll be doing. So just give your feedback in the survey, and we'll try to incorporate some of that for the next session. We can go to the next slide. So I'll cover three main topics for today. The first is to really understand what is riba and the impact that it has on Islamic finance. The second is, once we understand that, how to actually build a system, a Sharia compliant, healthy financial system. And the third is we'll go through some of those details of like what it actually looks like. Next slide. So I want to spend a few minutes talking about, what does avoidance of riba actually mean, and what does it look like in reality? And I think to really understand this, you have to take a look at it from first principles. A lot of the times when I talk to people about like Islamic home financing, regardless of what's being talked about, it's hard for them to believe that it can actually exist in the American ecosystem. And that's actually a very fair opinion to actually have. But to understand what a true Islamic financial ecosystem can look like, we have to talk about how transactions must share both in risk and reward. And if the definition of riba is to make money basically on money. What does that mean? Is that you're not actually taking any risk when you invest any money. You're just benefiting, but not taking actually any risk. So in order to create a healthy financial system, it has to involve both risk and reward. And actually, it's disputed of who it's said, whether it's Umar ibn al-Khattab or the Prophet Muhammad sallallahu alaihi wasallam. But the statement basically goes that to invest the wealth of an orphan so that it doesn't get eaten by zakat. So I'll say that one more time. Invest the wealth of an orphan so it doesn't get eaten by zakat. Now, the point is not to, some people's knee-jerk reaction to that would be to say like, well, you're just trying to avoid zakah by investing your money and stuff like that. But if you kind of peel the onion and understand, let's think about like when you actually pay zakah. Typically, you pay zakah on like the full 2.5%. You pay on cash, you pay on commodities, and then if you have a business, you're typically only paying zakah on the assets of the business. So there's a lot of wisdom in why that's the case. And if you think about it, it's because that money that's in cash or commodities is not being circulated in the economy. But when you have money that's being circulated in the economy, such as you're investing in a business, then you're really only paying on the assets that you have, not the full valuation of the business, right? So what kind of the principle of zakat and when you actually pay zakat teaches us is that there's actually nothing wrong with investing if you do it in the right manner, and actually investing in a proper method where you both share in the reward and the risk benefits you and benefits the person that you invested in, because the money is being circulated in the economy. The problem is when money becomes held by certain individuals or people, and wealth gets accumulated by only certain individuals, and the only way that others can get capital is by using interest-bearing instruments like riba and loans. That's when you have an unhealthy economy. And if you can go to the next slide. you see this kind of, I'm not going to go into details of what it actually looks like in reality, but from everything from international countries collapsing to real estate bubbles that have occurred to so many other things. All of these have fundamentally basically been caused by over leveraging and using riba. And the fundamental problem with the riba never aligned between the both two parties. In a fair financial transaction, well, you both participate in the risk and the reward. But in a riba-based transaction, only one person benefits, right? Like if you buy a conventional, if you buy a home on a conventional mortgage, you are on the hook for that house, whether anything good happens to it or anything bad happens to it. And that's not a fair transaction system where all parties benefit from risk and reward. Next slide. So, Islamic finance is not a new concept. It's existed for a while in America, I think probably since the early 2000s. Um, and I think the biggest struggle that most people have is understanding form versus substance. I'm not getting into the specifics of like particular companies or whatever, but most of what we've seen today in terms of Islamic finance has been contractually modifying the contracts and the agreements that a homeowner might have with a bank to make sure that they are Sharia compliant. But substance-wise, that's often been missing. And what do I mean by substance? The substance basically means the core principle of Islamic finance, which is you have to share in reward and risk. That is the core premise of Islamic finance. If you want to think about if you want to evaluate any, Islamic financial system, that's what I would tell you to look at is whether someone is participating in real risk along with participating in the reward. And those models have exist today, and lots of people use them. But there is a fundamental need, and I think the community is begging for better financial instruments that are more aligned with our faith and principles, where you share both and risk and reward. Next slide. So I think one of the this is based off of a Pew study I think that was done in I think mid 2000s, where it showed that Muslim Americans have a significant home ownership gap compared to average Americans. And actually, the study also showed that there is not a socioeconomic gap between the Muslim American and the average American in terms of income and stuff like that. But one can hypothesize that because of the lack of instruments that people feel comfortable with today, that's one of the reasons why we see a lack of in-home ownership. And one of my capacities is the co-founder of NIA, which I'll talk about a little bit later, that does debt-free home financing. And that's definitely something that we've seen with the people that approach us is that people have waited 15, 20, 25 years before buying a house because they do not feel comfortable with the existing options today. Next slide. So I think in order to understand like why, what it takes to build, a fully Sharia compliant model, fundamentally we have to build it from the ground up. So that could be like, co-op models like Amin Housing, for example, which has been around since I think 1996. That's one of the brothers mentioned, or even other. What we're doing at NIA is by, raising investors from individual investors. That's what really it takes to be done in order to build a completely Sharia compliant model. And you might ask why that's the case, like why can't we have a Muslim bank or something like that? The reason is because the banking system in the United States must conform to the Federal Reserve Bank, which requires you to kind of live in an interest-bearing system. So as a bank, you cannot take if you're in, what a bank typically does is takes the depositor's money and invests it in loans. But as a bank, you cannot invest in something like an Islamic instrument because you would be sharing in risk and reward. You can only invest in things like loans where the risk has been basically mitigated. So that's why some of the Islamic banks that have come about recently, they are still structured as loan structures because it's not necessarily even their fault, but the regulatory conditions do not allow them to take the risk of their depositors. Because imagine you had a bank account and you would face loss in the bank account because of the way that the bank invested in money. That obviously can't happen. People are not used to that aspect. So that's why we have to build things from the ground up, and that's why it's going to take a little bit of time in order to kind of figure that out. Next slide. So I'll talk a little bit about NIA and kind of how we work, which provides debt-free home ownership. But our model is, I would say, like 95% similar to Amin Housing, which is also based here. And I think there's a couple of people from Amin Housing as well, where basically the homeowner and the investors jointly basically purchase the property. So let's say the homeowner comes up with 20% down and NIA comes up with 80% down. What we do is that we determine what the market rent is, and then whatever portion that the homeowner does not own, that's the portion of rent that they pay for the house. And then whatever portion that they do own, let's say they own 20%, they pay 20% insurance, they pay 20% taxes, they pay 20% like major expenses like roof, etc. And then NIA pays its proportion. So if we own 80%, we pay 80% taxes, we pay 80% insurance, and 80% major repairs. And as the homeowner buys additional equity, let's say now it's 30/70 or something like that, that's how we will share the proportion of expenses. And that's again one of the core principles of Islamic finance is not only do you have to share in the risk and the reward, but you have to share if you're going to follow what they call the musharaka model, which is a partnership model. You have to share in the upkeep of the property as well. So like some people do this slightly differently. I mean, housing does like a discount on rent to accommodate for this. We just do it one for one, just because that's kind of what we've decided to kind of simplify the process. You can go to the next slide. And I think one part that I missed obviously is that so the investors own 80%, and then the rent that the homeowner is paying is basically distributed to the investors as rental income. And so just I'll talk about the next part later, but just to talk a little bit about like kind of how we differ from regular mortgages or what you might have seen of called like Islamic mortgages. We share. Go ahead.
It's pretty hazy.
Oh, it's hazy.
Make it more brighter.
Oh, the grays is intentionally.
No. Overall.
Oh, overall. I don't know if I it might be the projector. Yeah. I'll speak to it maybe if it's easier. Yeah. So we share both in NIA basically shares both in the profit and the loss. So
Could you also talk about how do you guys make money out of this? Because I don't understand. You're paying into the house 80%, but you have a business. So where are you getting the money?
yeah, so I'll explain that. So let's say the homeowner was to put in 20% and NIA was to put in 80%. As the homeowner is paying rent, that rent is distributed to the investors as rental income. And that's what the investors receive as dividends, basically, just like that they would buy a actual like rental property, same way. And then how we as the managers make money is that just like any normal investment fund would, there's a management fee basically associated with that. And that's what we as the managers basically make for that. It's like a reduced fee compared to other investment funds because we have obviously ulterior motives here to kind of help improve home ownership, but that's kind of what we do. So in terms of like how NIA operates, we share both in the profit and the loss. So let's say hypothetically there was sudden damage in the house in terms of roof or whatever, we would actually bear whatever portion that we own, we're going to bear that expense. We share whatever portion that we own, we share that in our property taxes. Same thing with home insurance and major repairs as well. And then we don't have a concept of late fees. We do not sell our loans to Freddie Mac or Fannie Mae. They would never buy First of all, we're not a loan; we're an equity partner with the homeowner, and they would never be able to invest in an instrument like this because they can't take the risk that is required for an Islamic financial instrument to kind of exist. And we don't have a concept of foreclosure. I can talk a little bit about kind of how we do that later. But this is very different from, I'm not going to mention like individual company names, but if you look at most of the Islamic quote unquote mortgages out there, fundamentally they do not participate in any risk. They do not care where you buy the house, whether it's in the swamplands of Florida, because at the end of the day, they take your loan and they sell it to Freddie Mac and Mac. They have washed their hands clean of basically that transaction. And so, from a contractual perspective, there might be legitimate ways that they are kind of fitting it into the system. But the grievances I think that the community has for so long about this model is that substance wise, it's been missing. And people don't feel that the current Islamic mortgages today cater to their needs because they just feel like, why shouldn't I just go get a regular mortgage if substance wise it's basically the same thing. So that's and Nia is not unique here. Like, once again, like Amin Housing is they have a slightly different model, but they are fundamentally sharing in risk and reward as well. Next slide. So this is a little bit where we are today. We're a fairly new company. We started about 2 years ago and really started scaling only about 9 months ago. And most of the homes that we actually buy are not in the Bay Area. That's why I would recommend if you are looking to buy a home in the Bay Area, like Amin Housing is honestly a better option. We're mostly spread across all over the U.S. We have about 6 in Dallas, a couple in Seattle, one in Southern California, and one in New Jersey. And we're raising about $2 million every quarter to kind of deploy kind of across the country. And the reason you might be asking, like, why are we in particular markets? So the rent that the person pays is not based off of interest rates. It's based off of whatever the market rent for the home is. So if you buy a house in California, you're buying, I don't know, $1.5 million house, and you only get $5,000 of rent for it. You would not even get like a 2% net return on that. But if you go to Midwest markets or even some East Coast markets, you can get 5-6% return on your investment, and those are the areas that we go seek. You can go to the next slide. So yeah, we have a wait list of about 3 years, and I think Amin Housing, I don't know what the wait list for Amin Housing is, but it's probably something similar. And because we are basically constrained by capital, not by demand. Actually, since starting 9 months, or since scaling 9 months ago, we already have a wait list of about 1,000 families for NIA, and that's without really any marketing. Because people have heard about the concept of Amin Housing for decades now, and there's nothing that has really catered towards kind of the rest of the United States. Next slide. You can go to the next slide. Yeah, I mentioned this before in the session that I had a few weeks ago, but I think one of the things to consider when you're thinking about an investment strategy is that as you get older and you have a shorter time horizon, a traditional investment portfolio has something called a fixed income component. So that's like something like bonds, because you can't necessarily take the risk of what has happened basically in the last 3 to 4 weeks basically in the market. And so I think especially for like our older generation, it is something to consider to think about what are alternative investments that you can invest in. And there's no such thing as an Islamic bond. The closest thing is called sukuk, which has a lot of international exposure. But I would say that the closest thing that follows true principles is probably real estate that has generally low volatility but also low returns. And so that's something to consider as you are kind of thinking about your investment portfolio. You can go to the next slide. So, and then you can skip to the next slide again. So I can just tell you that before starting NIA, my dad and I, we've been running real estate funds for almost 10 years. And we started off buying homes in the suburbs of Michigan. And we had about 100 homes there from 2016 into 2022. And one of the challenges that we faced was that every year and a half to 2 years, we'd have to get in a new tenant. And when you get in a new tenant, you have to change the carpet, you have to change the paint, you have to pay the realtor to put in a new tenant, and it actually significantly impacts the projected returns that you might have. And one of the beauties of this model, and that's credit to when you do things in the Islamic way, is that we've taken the concept of a short-term renter, a traditional landlord and a tenant relationship, and actually now the renter is a part co-owner. He's in a long-term rental relationship. So we no longer, typically when you underwrite a rental property, you underwrite on 11 months of income because of potential vacancy. We no longer have to do that. And not only that, our tenant and co-owner is going to take care of the home completely differently than a normal tenant obviously would. And they also take care of some of the minor expenses that are as part of the home as well. And so, point being of this slide is that the Islamic model is always better. And that's for both the investor and actually the renter or part co-owner, because both people, as the investors, we are benefiting from a tenant who cares about the property and is paying us, decent rental income. Next slide. So, compared to a traditional rental income property, having you benefit from the same rental income and appreciation. All you're doing is buying 80% of a home instead of 100% of a home. The home is occupied by the co-owner. There's no tenant turnover, and the tenant handles the minor maintenance and stuff like that, like appliances or light bulbs or kind of whatever. So from a purely, like, if I was looking at it from a purely residential investor perspective, and that's why we do not do any more residential funds as kind of our real estate funds, this model is far superior to invest in residential real estate than buying a traditional income property. Because once again, we're using the same rent metrics. The person is buying the home over time at whatever the market value is. And so it's really a win-win scenario for all parties involved. Next slide. So this is just kind of one of the homes that we've purchased in Dallas, bought it for around $600,000, and we invested 71%. The person put in 29%, and it gives us about a 5% rental return. I know there's a lot of questions, so I'm gonna wrap up soon, and then we can address those. And go to the next slide. So in terms of our investment structure, I'm not going to talk about it too much, but if you're interested, we do about 5% rental income and 2 to 3% in appreciation. You can reach out to me after. We can talk about it if you're interested. But our investment is only available for accredited investors. So that means you have to make at least $200K as an individual or have $1 million in net income. I don't think Amin Housing has this restriction because they're a co-op. So if you are interested in investing in real estate and you don't meet that criteria, you can definitely check them out. You can go to the next slide. This is a little bit about our team. We have Safeer Mohiuddin, who's our Sharia advisor. And like I mentioned, we've been doing this for about 10 years before Nia. You can go to the next slide. I think this should be the last one. Okay. One other point, just because this question that I get a lot is like, what do I think about the market and where things are and stuff like that? Most of the homes that you see today were basically built after World War II in the 70s and the 80s. And we have about a 10-year shortage of residential homes in the United States, and actually it's even more in the Bay Area. And then with all the other things going on with like tariffs and immigration, I would argue that in the long term, home prices are probably going to go up even further, because there's everything tariffs on like PVC, like plumbing pipes to wood, and then there's already significant labor shortages, and that's just even going to get worse. So I would imagine that the housing price market is going to go up even further. Now, we do in the US have to, the other factor is interest rates, whether we participate or not in that aspect. Interest rates do impact homes. And I don't think interest rates are going to go down, but they might, there might be like a 1 rate cut at the end of the year or something like that. And if interest rates go down, then home prices will go even further. So all in all, to say that I think investing in something like real estate is a much more resilient asset compared to investing in more volatile things. That's not to say invest in one or the other. You should have a mix, and like we talked about in the last session. If you weren't there, then check out the Tawasa YouTube channel, and you should be able to find that. Next slide. Okay, yeah, if you're interested in the investing part, just go on our website and sign up. But we can switch to questions now because there's always questions about this. Yes, go ahead.
So I get you do not do refinancing this purchasing value.
The question was, do you do refinancing? We do refinancing. Refinancing. We've done 3 refinances so far. We basically buy out the loan holder, whoever it is, and then we come together for our standard partnership agreement. So yeah. Other questions I can answer? Yeah, good question. So for us, we've structured it a little bit differently. So typically, in a normal, the question was about how does the payment work over the period in a mortgage term. So we've structured it a little bit differently, where the only obligation that the tenant has to make after making at least a 20% down payment is their portion of the rent and their portion of major expenses. So let's say, for example, that the rent for the home was $2,000 for the sake of the argument, and the person put 20% down. So they have to pay 80% of the market rent. So that would be, I don't know why I'm blanking on the math, $1,600 basically that they would have to pay for their portion of rent that they don't own. Now, let's say that the taxes and the insurance for the house are $1,000, just to use round numbers, and they own 20%, so they're going to pay $200 of that. So their only obligation is $1,600 plus $200. So that's about $1,800 total. So that is the only thing that you have to pay. And in NIA's model, at least, you are actually not obligated to purchase any additional equity in the home. And the reason why we designed it that way is because when you force someone to purchase the home, that's when the contract gets very hairy. Because technically speaking, we're in a partnership model, so you cannot force someone to. You cannot have like a predetermined price of how they should be buying out your equity. So what do we do for the equity portion? Like, how do you build equity into the home? So what we do is that we take the assessment, the value of the home, and we reassess it basically every year. And we use basically, the government basically publishes data called HPI, which is in the metropolitan area, how much should house prices appreciate or depreciate. So let's take an example. Let's say the home, we bought it for $100,000, and let's say the home went down, and the values in the area went down 5%. So they went down, the house went down to 95K. The homeowner would be able to purchase equity from NIA at the actual 95K value, not the 100K value, actually at less than what we purchased it for. And NIA would have to participate in that loss. But the same thing happens if the value went up. So if the value goes up, let's say it went from 100K to 105,000, they can buy a certain amount of equity at that 105K value. So an example, let's say they're buying 5% of the home, and let's say it went up to 105,000. So they would be buying, $5,000 of equity for $5,050 basically, right? That's fine. Did it go up by 5%? 5,000. Yeah. No. $5,250. So you'd be paying a $250 premium, I guess you can say, for the equity, because that's how much the value of the home went up. Now, if it went down from 100,000 to 95,000, you'd be buying that 5% of equity for 4750, right? Now, question that we often get is like, okay, well, house prices are going to go up every year, like it's gonna be it's kind of too much of a black box. So what we've done is we've set a cap that the price of the home cannot appreciate more than 5% every year. So let's say it goes from 100,000 to 106,000. Doesn't matter. The person is allowed to purchase a certain amount of equity at the 105,000. So that's on the upside cap. And from a Sharia perspective, you cannot have a downside cap. So if the house goes from 100,000 to 90,000, 80,000, whatever it is, the homeowner can purchase some amount of equity at that value. Now, the last piece to that equation is like how much can they actually buy? So basically, they can buy 5% year one, 5% year two, and then year three, four, they can either buy us out completely or they can buy 10% at a time. Now, why have we structured it that way? It's because let's say the house went down for 10 years, basically every single year. We have to participate in that loss. And that's kind of the true financial model that we're following. And so we want to spread out our risk such that any particular like year, if it downfalls, we're not going to be taking on kind of all of that loss that we can kind of spread it out. So that's kind of how it works. And I mean, housing works slightly differently, but core premises we share basically the risk. Go ahead.
So what happens when the person that you have a contract with, the property dies, and how does that go to their inheritance?
It's the same way that how you would, if you were to own a home completely right now. So the way that we are not a lien holder, there's no loan on the deed. We sit jointly with the homeowner on the title. So it would say like homeowner and Mia, and in a separate like county recorded document, we say like homeowner owns 20% and Mia owns 80%. So however you have it structured in your will or living trust, that's how it would flow down to your inheritors. I do highly recommend that if you do own assets like a house or whatever, you do consider getting a living trust. And you can, on the website Muslim.finance, there's a link to, I don't have any affiliation with them, but it's called Sharia Wiz, WIZ.com. And that it's like an online system where you can actually get a living trust, and it's pretty reasonably priced. I think it's about $850 or something like that. So if you don't know what a living trust is, you can basically, typically, if you pass away, your assets go to like a probate court, and it's a very painful process for your inheritors. But a living trust, which typically comes with a will, you can kind of avoid that process. Yeah. Other question?
I have a question from the management perspective. Like you already mentioned that there are about 1,000 families in line, and then of course the demand is the money constraint that you have. So now the thing is, when you invest in a property with somebody else, you get form the money comes back to you in the form of drip, right? It's like a store, and that's why there's demand for the capital. So how do you plan to address this? You have families, and how do you plan to scale through that?
Yeah. So the question was around like how do you plan to scale given that you have about 1,000 families on our wait list and we have limited funds? There's two things basically that we're doing. One is that we are focused on markets outside of California because the home prices outside of California are generally much cheaper, and we can help more families that way. So we're typically not giving more than 400K from our equity side. In some cases, we do go up to 500 or 600K, and that's typically sufficient for if someone brings in 20 to 30, 40%, we can still buy a 700K home or something like that together. So we're prioritizing people that need the least amount of financing or equity financing from our side. And then the second thing is that we are scaling up and being more public about the investment options and stuff like that. Now we are, as NIA, are a little bit more constrained than Amin Housing because we are a registered 501(c) investment fund, which basically means we can only take accredited investors compared to something like a co-op. But eventually, one of the reasons why we structured as a for-profit company is because we can go seek institutional capital once we have a 3-year history. Typically, like with most co-ops, that's more difficult to do because it's a volunteer-run board and endowments might have hesitation kind of towards that. But that is basically our goal, is once we hit the 3-year market, then we can go seek institutional capital. Now, what does institutional capital mean? It typically means like endowments, insurance companies, etc., who will invest money. That does not mean selling to Freddie Mac, etc. But it would be how they invest with us would be identical to how a normal, basically, investor would. Other question?
So if we look at it from the investor perspective, how do you base the money on shares? Do you sell it? How do you match? How do you? If I enter, I will join you, for example, and then I want to leave. How does it work? Because with funds, for example, there is a price, and it appreciates and depreciates with the market. And you're doing the exact same thing with the house because you calculate the appreciation and depreciation of the house. So this means the investments will also appreciate and depreciate, which means you should be selling equity or some form of a share on that.
Yeah, that's right. So the question about like how does it work if someone invests and then they leave? So yes, when you like join as an investor of NIA, you get certain amount of shares, and that the share price basically adjusts on a quarterly basis. So far, we have not done that, but we will doing that because we adjust our prices of our homes on an annual basis. So most of them actually have not passed 1 year period. So basically, the way it works is that if someone buys actually equity, that's the proceeds, the gains are distributed to the investors. But the remaining part, we adjust basically the share price based off of the aggregate value of the homes. And then if you were to leave, someone would basically buy you at that price. So you can leave with a 3 month notice for our funds. It's an open-ended fund. Obviously, the money is tied into assets, but we have new investors coming in, and then we have some anchor investors to kind of help if people need to leave, basically. So that's kind of how it works.
Within the 3 months, the price of that share will be based on last year's evaluation.
We assess the share price every quarter because like we bought a certain amount of homes in June, we bought a certain amount of homes in September, right? So whatever quarter period when those new assessments happen, we calculate the aggregate value and then we adjust the share price. We haven't done it yet, but we will be doing it for next quarter.
We have a method to assess that.
To assess like the home prices,
The shares.
it's directly based off of how we assess the home prices. So we use something called HPI data again, which is like government publishes data of like how much properties moved up or down in a certain regional metropolitan area. That's what we use to adjust the home prices, and that kind of the agreement that we have with our homeowners, and that gets directly impacted to basically the share price because the fund directly owns equity ownership basically in all the homes. Other questions?
So you don't do home appraisals?
We do home appraisals. It's not like we do like an e-appraisal process, but we do a home appraisal and then we do an inspection process as well when we evaluate the home for considering it to what we want to invest in. Yeah.
Just initially, that you don't do it regularly to kind of value the property?
We do a home appraisal. We don't do home appraisals annually to assess the value. We use HPI data, which is the metropolitan area. So it's not specifically tied to the house, it's tied to the metropolitan area. Yeah.
So what is your rate of return to investors?
The rate of return is about 5% rental income and 2 to 3% appreciation. We've been averaging about 5.5%, but that's kind of what we target.
The other side, from the homeowner's perspective, let's say you go into a partnership together for 5 years, and maybe the house appreciates whatever, and I want to go out, like I want to sell. Do you sell the whole house, or do you let someone else do it?
Yeah, we sell the whole house, or we can buy your share. The question was like, let's say someone wants to sell the home after 5 years. Yes, you can sell the home anytime after 3 years, and we will either buy your portion or we can go on the market basically and sell it.
So you cannot sell it for the first 3 years at all?
The first, unless there's like emergency cases, but yes, we try to restrict at least for 3 years just because there are closing costs associated when we initially buy the house.
Can we, for example, partner in the house? I live in it for a long, but then rent it to someone else?
No, yeah, so our model does not work with rental because the monthly payment that you pay is the market rent of the house. So it just would not financially make sense for you to buy a house with me and then rent it. And for us, our model is geared towards only homeowners. That's why it works. Um, yeah. Unfortunately, with our model, like you have to basically live in the house. If you need to leave, then you would have to sell. You would have to basically sell the house, or we would have to buy you out because our model is structured on long-term tenants, basically. Yeah. Other questions?
First of all, nice presentation. So how do you guys deal with the riba interest? Like from our side, we don't have the peace of mind that oh, we don't have to deal with that. But how do you guys like? I know in the United States there's no way like you have to deal with buying the investment property or anything. So how do you guys like deal with that part?
Yeah, the question was like, how do we deal with riba and interest? So there's no riba or interest involved in our transactions because we field our investment money that we are deploying from private investors. Private investors like yourselves or other Muslims who want to invest in residential real estate, who are obligated to abide kind of by our principles that we have in our company. So that and those principles are basically that we have to share in risk and reward, right? That when we make an investment into the home, if there's expenses towards that home, like let's say there's a some disaster that happens in the home, we have to cover our portion of those expenses. And so we're not a loan structure. We don't sell to any bank the financing that we do, and that's how we're able to maintain kind of a no riba infrastructure. Yeah.
So what's the minimum investment in your portfolios? And then also, if someone puts an investment, does it go to one property or does it go to many properties?
Yeah, the question was like when you invest, does it go towards one property or many, and what's the minimum investment? Our minimum investment is 50K. And in regards to the second question, no, when you invest in the fund, it gets distributed across all of the homes. So we have 15 homes today. And that's one of the reasons actually we stopped buying individual rental properties and just invested in the fund is because it's distributed across us, all the portfolio. So if one thing happens with one house, the risk is actually distributed across all of them. So the fund can take hits basically on one house. It's not going to impact basically the entire investment. So the fund that the investors invest in directly owns property interests. Is on the deed. If you look up like one of our houses, it'll literally say NIA Fund 1 and homeowner. So we're actually on the deed. So all the standard benefits of investing in real estate, like depreciation and stuff like that, you also benefit from as an investor. Other questions?
Yeah. What if somebody wants to make an improvement in the house?
Yeah.
2-acre lot and has only like 2-bedroom house and they want to make a 5-bedroom.
Yeah. So the question was like around improvements and what happens then. So we don't have a perfect model right now, but basically we're mostly targeted towards ready homes. But if you want to make improvements on the house, what we do is if you make improvements on the house in the anticipation of selling, so basically if you sell the home within 5 years of making the improvements, we will hire an independent appraisal who will assess basically what the value that you added to the home that was. Let's say you added a new bedroom and improved the house by 200K, and then we will add that as a credit for when we sell the home. So let's say you're 20/80, so 20% and 80%, and let's say we sold the home for a profit, it would be 20% plus your credit basically for your equity. If you do not sell the home in 5 years, then we don't take that into consideration, basically. You would be paying that improvement basically on your home. So it's not a perfect model, but we are basically we are constraining ourselves to basically homes that are more ready for the person to live in. So we don't do like fixer uppers or basically anything like that.
One more question. So the quickest buyback the home would be like 10 years?
3 years, 3 years. Yeah. So Year one, you can buy 5%. Year two, you can buy 5%. Year three, you can buy this out completely. What portion of the outsourcing? Sorry, I didn't follow. I don't know if I said field out. So I guess the question is, how do we kind of avoid riba? We do not sell. First of all, we don't have any loan structure in our when we do a transaction with the homeowner. It's not a loan structure, so there's no like a lien on the house. We jointly own the property with the homeowner. And then the way that we source our funds for actually like buying the house is we have private investors. So we're not selling to Freddie Mae, Fannie Mae. So there's no interest, debt, or whatever involved. We are just sourcing our capital from people who are actually investing in the fund. Yeah, so there's no interest or leverage. We don't even have like late fees for kind of our home.
It sounds like you guys can maybe down the future, you can just sell stocks, like shares in the market, right?
And like
You know, the IPO on your.
question was like, can we like IPO or something like that? Like, yes, eventually we could.
How are you going to avoid the riba?
No, it's not.
Once you go into the public markets, you are tied to the whole system again, right?
Yeah, so I think there are some potential caveats. Yeah, you can expose yourself to basically people taking ownership of the company in the public market by doing that. I think you can become a private company that's publicly listed, not on the stock market, but there are other kind of methods to do that. I mean, that's a long way to go right now. Like we are focused on seeing if we can get to $50, $100 million, basically.
That's why you guys have a non-traditional investors, right?
Yeah.
Because traditional ones wouldn't want to go down south.
Yeah, the question was like, you have non-traditional investors. So I would say that is somewhat true. So there's a company actually that's similar to ours called Wayhome in the UK, which is very similar conceptually to kind of how they're structured, but they actually got investment from insurance companies in the UK that invested in them. And I don't know why, but I can hypothesize is that because if they wanted to leverage on their own, they can still do that outside of the investment. But also, like we kind of talked about, the model of having an owner-occupied tenant is much better in terms of returns, kind of from an investment perspective. And so, and these insurance companies have become much more investing in like real estate, residential and commercial. So there is an opportunity for us to go to institutional capital. Typically, it's once we reach like a 3-year time horizon and have probably anywhere from 25 to 50 homes. So our target this year is to hit about 25 homes. Today we're at 15. Yeah. Other questions? No other questions?
How about the rent prices? Is it gonna be like flexible just because of rates, inflation, or you guys have a kind of.
Yeah, so the question was, what do we do about rent prices? So I think similar to Amin Housing, we also reassess our rent prices every year. We have just like the equity portion that I mentioned, we have a cap of 5%. Rent prices cannot go up more than 5%, and there's no downside cap. So even if the rent prices fall 20%, we have to basically participate in that. Our rent prices are independent of the home price adjustment, right? They use different mechanisms to adjust those basically rent prices. Other questions?
So the bottleneck is the investor.
The bottleneck is the investors because we cannot go and get banking capital because they will never take the risk that's needed for this to be truly Sharia compliant. Yeah.
Oil shakes.
Yeah, I don't know. Yeah, but it's a process, and I think, like I was mentioning, we as Muslims do not have a fixed income instrument. So this is kind of a good alternative for that, and I think probably most of our community is probably a little bit overexposed to equities, or just hold it in cash. I don't know. Yeah.
So how do you qualify a person for either purchasing or refinance?
Yeah, the question was how do we qualify people for purchase or refinance? So we take their income into consideration, and we take into consideration how much the projected rent is going to be for the house and the expenses, and whether they can do that. One question that we get asked a lot about compared to traditional mortgages is, do you check credit score? So we do check credit score, but there is no, in traditional mortgages, the rate that you get is impacted by your credit score. So we do not do that. The amount that you pay for rent is rent. There's no, it's not based off of interest or what the rates are basically. It's based off of whatever the market rent is. So the amount that you pay is independent of whatever your credit score or whatever is
So what do
basically.
you check it for?
We check how much money that they're making and whether the income to payment ratio is sufficient. Like in a typical mortgage, it's typically 36% debt ratio in a typical mortgage, which is like the payments cannot be more than 36% of the income. So we don't have that exact figure, but we basically check of whether the person can actually make rental payments and the major expenses payments that they have as well.
What about the people who, like, small business owners, their income is not shown as much? Like the other regular brokerage companies or lenders will consider that.
Yeah, so the question was like, do you consider like if you have a small business and income? Yes, we do. So it's not just like, so those people typically have not as great credit scores too because of that. So we do take into consideration of small business income and stuff like that. Other questions? I think I saw hands somewhere. No? Other questions?
I think you have a good foundation and the projected.
Yeah, we're pretty early in the process. Like I said, Amin Housing has been 1996, right? So 1996, yeah. So our model is like 90% based off of Amin Housing's model, but yeah, we have a long way to go to build a truly financial system, and we'll get there slowly and inevitably. Inshallah.
So the question, since you guys said that income also, so rental income coming under the profit sharing.
السلام عليكم. سنقيم صلاة العشاء.
Okay.
And just sort of quickly is that, so how do you plan to have, I'm good with this, I'm just lost my thought train of thought. Sorry about that.
Well, if you have any questions, I'll be around, inshallah. Thank you. Assalamu alaikum.